I want to thank everybody for joining us. I'm going to go ahead and get started. We have a few more people getting logged in, but we'll go ahead and get started. Introduce myself, Rob Cruz, president of Cruz and Associates. And our topic today we're going to talk about is how to increase the cash flow of your business in just 10 minutes. It sounds kind of crazy, but it's something I've learned and we've taught our clients over the years that there's certain things that you can look at, and we'll talk about that in just a few minutes, that helps your business and you can make adjustments that once you learn all those things, it takes about 10 minutes each month to do it. So first thing we're going to talk about today's topic is a former business owner once told me in the 7 years that they were in business, they prepared 3 financial statements. 2 of those were to get a loan from the bank, and the third one was for the bankruptcy court. And my answer to that business owner was, or that I guess ex-business owner at that time, or we were talking, is business is just a game of numbers. The person who learns to control the numbers best wins. So that's what we're going to talk about today, is how to look at your numbers and how to learn to and control them a little bit and make your business better. Because I can guarantee you, from my 28 years of doing this, I've only once or twice I've ever told somebody to get out of business because of lack of sales. Typically, it's more it's not so much the money coming in, it's how the money is going out. And so our goal is to give you some insight on how to use your most powerful tool in your business toolbox, and that's your monthly financial statements. First, I want to talk about is lump accounting. There's 2 types of accounting in this world. There's income tax accounting, and then there's what we call lump accounting. And so first thing we want to do is in lump accounting talk about lump accounting. Lump accounting will work for your tax return, but does not run your business. So an example of lump accounting is when you're seeing stuff like all your sales are one big number. Here's like all those sales, basically one big number. Cost of goods sold is one big number. In this particular case, this is what on the Bad Restaurant Corporation. They're actually including sales tax into their sales numbers up here, and then decreasing and then expensing what they're paying the sales tax. For tax purposes, that's fine. I mean, it's income and expenses, but truly, sales tax is not income, and it should not be included in your income, as the fact that it's just a pass through. It's actually a liability to the company that is then paid out once a month to the state and so forth like that. Other thing you'll see is like right down here is we have wages, one big category, wages. These are and your payroll taxes, all one big category. These are your 2 biggest expenses in most every business, and to manage them properly, you need a better detail to do that. So that's what we're going to keep talking about today. And the other thing about this financial statement is there's no percentages. That's not uncommon with a lot of the software out there today. But the thing is from a management perspective, percentages are more important than the actual numbers. From a tax return perspective, this is all fine and dandy, but from a management perspective, these, like I said, it is more about the percentages than it is about the numbers. Some of the problems with lump accounting, like I said, it's hard to do industry comparative analysis. Yeah, you could sit there and say add this number, add up that number, divide by that number, and get to where we need to go. But it's a lot better especially if you want to do it in 10 minutes every month, is to have those numbers already broken out and in the categories. Also, I was going to say, I forgot to mention at the beginning, there's a Q&A function on your screen. If you have questions, please feel free to write the questions to me. I'll repeat them, and then answer those questions as we go. Because and most importantly, this whole thing is about asking questions. It's is answering your questions. So, okay, back to where we were here. Next problem with lump accounting. It's hard to know what is making money and where you're losing money at. Very common. Careers and Associates, for example, but we consider ourselves to have 4 departments. Every month, I get a report showing if a department makes money or a department's losing money, and year to date. And I have that history for years. So I know if some department's consistently not making money, or it's making less money than it was last year, I can focus in on that one department and see what's going on. Percentages are more important than dollars. But like I said, you want to make sure those percentages are on your financial statements every month. Now what is management accounting? That's the opposite of lump accounting. Okay, and like I said, in management accounting, the business is just a game of numbers and percentages. And the person learns to control the best wins. And that's what we're going to focus on today, is learning how to control those numbers and learning how to make those work to your benefit. Okay, I can guarantee you, you can easily add 2 to 5% to your bottom line in just 10 minutes. Increase your profits with some. There's 2 factors. There's the income statement and there's the balance sheet. First part we're going to talk about is the income statement. How to increase your profits with your income statement. Keep in mind, and I've had clients tell me, what's 1 or 2% on my, what are 1 or 2%? What's that really mean to me? My answer is very simple. If your business grosses $1 million a year, and you add 5% to your bottom line by tweaking some of these percentages or tweaking some of these numbers, you'll add $50,000 in profit to your bottom line. That's what so on $1 million business, 1% equals $10,000. So if you can make some adjustments in your business and increase your profits, decrease your expenses by 5%, you can increase your profits by $50,000. Here's an example of what we call Good Restaurant Corporation. Okay, notice there's percentages for everything. We also have stuff broken out. We have the sales broken out, and then we have cost of goods sold broken out into different departments. Nice part about all of this is the fact that we can do comparatives. And then we have the total cost of goods sold. We have labor. We have labor broken out, and labor is broken out into its own separate department. And then your general and operating expenses are broken out into marketing, into direct operating. And like I said, percentages are on the financial statement there because they're more important than the actual dollars. Because in business, you have variable costs and you have fixed costs. Your 2 variables in most businesses are your cost of goods sold and your salaries. Those are your 2 big variables, your 2 big normal variables. And those are the ones you definitely want to be watching, because there's also your biggest expenses. And as we go down the financial statement, we have repairs and maintenance, we have general administrative, we have utilities all broken out. And then within the utility, instead of a utility account, we have the utility accounts broken out to each different utilities. So you can see at a glance if something is different than last year, or higher than last year, or doing better than last year. And this is just the net income. Now, the next thing to know, once you get your financial statements into a position that you can actually start looking at them out and knowing what you're not, and you need to know what your percentages or where your key and strategic indicators are. Every business has them. We have reams and reams. We have, well, I could say we used to have books and books, but now it's all online. But on our server, but of every industry, what their key ratios are and stuff like that, and what the percentages are. And we use those when we're working with our clients on a month-to-month basis. It's important to know your key strategic indicators, or KSIs. For a restaurant, the example we do today is for the restaurant. Just a few of them. And there's just a few of them that are very important to know for a restaurant. No, they are sales growth over last year. Food cost, beverage cost, beer and liquor cost, if your restaurant has beer and liquor, labor cost. And notice we're separating all those out because it's important to know all of them separate from each other. So now let's go back and look at the Good Restaurant Corporation. Right here we have sales, and sales does not include sales tax. In the second and third year, you can do comparative analysis to see, how your sales are reporting over last year. Cost of goods sold is broken out. Same thing. Not just knowing what the cost of goods sold is important. It's having it broke out. So when you do sit down and say, hey, what's my cooler? The particular client broke it out into a freezer. Okay, the stuff in my freezer. Okay, amounts to 12% of my sales. And then as we look at it next year, if that 12% snuck up to 13%, you can focus in on what areas. It's more easily to focus in on what area has changed. It's caused your overall percentage to go up. Your labor cost breakout. Once again, it's broken out. This particular example breaks it down between owner's wages, staff wages, clerical, and compensate and commissions. So once again, you get your total, you get your payroll taxes, you get your total, you know what your overall totals are, and you know what each department within that. And those departments don't vary from business to business, company to company, industry to industry, and not all, even within the same industry, not everybody was broken out exactly the same. But it's important, like I said, but it's all important to know. Then the next thing is know how your business stacks up against your industry. If you don't know I'm a firm believer, if you don't know where you should be, how do you know where to get yourself there? Know your key industries, your industry KSIs. Sales growth over last year. Any business should do 4 to 5%. That's why I believe. I'm not saying there's not an occasional recession year or something like that, but in general, that's always a good goal to hit to shoot for 4 to 5% over last year. Food cost sales should be 27 to 30%. Beverage cost should be 25 to 27%. Your beer and liquor should be 25 to 27%. Labor costs should include payroll taxes. Including payroll taxes are 27 to 30%. So now we're going to go back to Good Restaurant Corporation here, and we're going to point out a couple of different things. Food cost of goods sold is 28.75%. Definitely within your 27 to 30% goal. That's good. Not saying there's not always room for improvement. Every business has it, but you're definitely not an area that you have to concern yourself. Should have to overly concern yourself with. Labor costs should be 27 to 30%, and you'll notice on the total sales, salaries expense is 33.4%. So they're actually over. Now, where are they over? Who knows? But that's just broken out. We can take these same breakouts from the last year and compare and see what department has actually increased over last year. Is there a reason that it's increased? Maybe added staff and sales haven't caught up with you. There's a lot of factors, but it's a difference. But it's a difference between knowing that you're that you're not efficient in an area, and then not knowing you're not efficient in an area. So, so what's that mean? Like you said, what's that mean to a client or a business owner? On $1 million in sales, that 3.4% overage was $34,000 that was taken out of the pocket that year. How do you apply this to other things you should apply to your business? All aspects, you should look at all aspects of your financial statement. There's other key factors that you should look at. Sales per employee is a good one. Okay. A sales per customer is a good one. I mean, knowing what your average ticket cost is on a customer, what your average sales is for a customer. Is that increasing over last year or decreasing over last year? Cruise and Associates, we track all these statistics. Sales per square foot. That's a big one, retail. It's not so much in service businesses, but it's a big one for retail. Nebraska Furniture Mart has the highest sales per square foot of any furniture store in the nation. And I'm sure we've all been to Nebraska Furniture Mart at some point in time. They run a lot of people through there and stuff like that. Next thing I do is that's important is make sure your bankers know that you love, make your bankers love your business. Tips to help your business get the next bank loan. This also gets into industry ratios and analysis that we were just talking about. So, but the bankers basically do the same thing, but they're doing it differently. They're not looking at your food and labor costs, they're looking at your balance sheet. And we're going to talk about the KSIs, the key strategic indicators that the bankers need to look at. Like I said, bankers love your business, and the owner and the bankers love it when the owner knows all about the details of the business. More than once, I've sat down with clients and I've sat down with bankers and said, you know, labor cost should be 27 to 30%. We're running at 33%. These are the things that we have put in place to make that correction. Bankers love that. I mean, they love the fact that you know more, you know about your business and how to do your business just as much as they want to know that you know how to turn a wrench or flip a hamburger. Okay, these are the KSIs. The KSIs that the bankers look at are different than the ones that we talked about earlier. They get more into the balance sheet. They want to know what your current ratio is. They want to know what your quick ratio is. They want to know what your long-term debt coverage ratio is, their cash flow ratio, and your working capital ratio. Those are the ones that are important to the bankers. But the process is the same. You know, I've dealt with bankers for years, even with building my own company and building my own business. And I've always had one rule anytime I've dealt with a banker. I said, I don't care if you say no, I'm a big boy, I can handle that. But I want to know why, and I want to know what ratio is off so we can work to fix it. And because that's how a banker works, that's how they make their decisions. I mean, yeah, there's a lot of decisions based on, you know, how their comfort level with you and your business, but they also have to get through the ratios. So let's talk about. I mean, here's an example of a good restaurant corporation's balance sheet. We have inventory broken out. So you know where the inventory is, and notice the inventory if you didn't notice enough, the inventory departments match the departments of the cost of goods sold. We have property equipment, we have other assets, current liabilities. This particular example doesn't have any long-term liabilities, and then equity. That's things that those are the things that the bankers really care about. Good financial statements. The owners who understand their numbers, owners who work on their business and not just in it. I'm a firm believer. I spend 1 hour a day working on my business. I've done that for years upon years, and that is makes a real difference over the long term. Some of our takeaways today. Let me check here, make sure okay. Yep, no questions. No questions just yet. So once you know your KSIs, it should take you about 10 minutes to analyze your financial statements each month, because you know those percentages. You can look at the financial statements and say, hey, what are we doing? How are we doing? I get a report every month on our financial statements of our labor costs, one of our big KSIs for Cruise and Associates. And I can tell at a glance by a report that I create, that generate, that's what the labor cost was year to date for the last 4 years. And I can see if if we're growing or if we're doing better or we're doing worse. Information is in the details as opposed to the lump accounting. Like I said, lump accounting works for tax purposes, but it doesn't help you run your business as efficiently as it could. Those numbers could. The balance sheet is just as important as the income statement, especially if you're when you deal with banks. Having good financial statements is key to your business success. You should spend at least 1 hour a week working on your business and not in it. And this is just one of several strategies that we can employ to help increase your cash flow, but it's really the one that we start with. A lot of the other strategies are effective, but this is the big one. I mean, getting known where you're at, making sure your business is under control, and having a plan. If there's areas that are out of control, putting a plan in place to get it in control. Cruz Associates, we feel every business owner's greatest tool is their financial statements. It's someone to help them understand the numbers. And that's what we try to do when we work with our clients on a regular basis. In closing, Cruz, our goal is to help you and your business be more profitable, answer all your questions in a timely manner, provide clients with education to make informed business decisions in all aspects of the business, not just their taxes. Our promise to all of our clients is we will always return phone calls and emails promptly. Trust in the fact that you always pay the least amount of taxes. Do not pay a penalty because of our strict adherence to deadlines. Our staff will haunt you to get your information into us to meet those deadlines. And find peace of mind knowing that you always know your fees in advance. We try to put all of our fees in advance. We don't bill by the hour after the fact. So those are some of the things that we try to do with clients. Disclaimer, the standard disclaimer that we need to put in there. And then at this point in time, if there's any questions or anybody has any questions or anything and needs any help or has any questions, please feel free to ask. You can also email me with questions if you have specific questions about your business and stuff like that. Well, on that note, like I said, if there's some questions, feel free to ask. But on that note, feel free to, like I said, email me questions afterwards, and we'll go from there. Appreciate everybody's taking some time to join us this morning.